Are you thinking about taking your company public? There are a number of common reasons why companies decide to go public. Companies may go public to raise capital, increase brand awareness, and increase transparency to inspire faith in their customers and clients. Going public is a major decision, and there are a number of steps that companies need to follow. First, the company has to connect with a reputable underwriter. Companies should work with an underwriter that has a good reputation, a strong IPO track record, and a solid level of expertise in their specific industry. Then, the IPO underwriter will conduct plenty of research into the company to make sure there are no surprises when the IPO begins. These surprises could impact share pricing. The underwriter will make sure the company's finances are in order and that all due diligence is conducted. The next step in the process is the SEC review. The underwriter will collect all the necessary documents to go public and submit them to the SEC. The SEC will review them before moving the IPO process forward. As the SEC reviews the documents, the company will go on a roadshow. This is a marketing strategy where the company gauges interest in the company's IPO. This information is important because it helps the company and the underwriter price the shares and determine how many shares to offer. There are a number of significant factors that will play a role in the number and price of the shares released for the IPO. This includes the amount of capital the company wants to raise, the company's overall valuation, the results of the roadshow, and the anticipated demand. Once the IPO has been approved by the SEC and the number of shares has been set, it is time for the launch. Typically, the company announces the date of the IPO in advance so that investors can prepare themselves to purchase shares. On the day of the IPO, the closing will take place. Typically, the stakeholders in the IPO, including the company's transfer agent and underwriter, will attend the call confirming share amounts to be issued by the transfer agent and funds to be sent from the company to the underwriter for the stock that was sold in the offering. Once this call is completed, the transfer agent will issue the shares for trading into the stock market. Following the IPO, there is a 24-day quiet period where the underwriter can execute trades to influence pricing and stabilize the share price. SEC restrictions on price manipulation are typically suspended during this period, but investors are required to observe the lockup period rule, which prevents them from selling their shares for 3 to 6 months. This is important for stabilizing the company's share price before it transitions to market competition. If you're thinking about doing an IPO, finding a transfer agent to guide you along the way is imperative. Colonial Stock Transfer can do just that, helping hundreds of companies obtain and maintain listings on NYSE, NASDAQ, and OTC. We are prepared to help you succeed. Are you thinking about taking